Good evening and welcome to Mortgage Coffee Talk. This is my first episode discussing mortgage related issues. Before I begin my program, I wish best for all our health workers who have put their life online to defend and fight coronavirus. May God keep them safe because they have put their life online to protect all of us. We salute them, we thank them for their service. Thank you. As you know, the corona pandemic has caused tremendous stress throughout Canada, even globally. Government has initiated various programs to help you get your financing. They have Canada Emergency Wage Subsidy for employer, giving up to 75% of the employee's wages up to $847 per week. They have also initiated $2,000 per person for 4 months to apply if they do not qualify for employment insurance. According to the Canada CRA website, if you have applied for employment insurance, you should not apply for Canada Emergency Response Benefit, which is $2,000. They have also initiated $40,000 loan program through the banks. So I am observing now that majority of the bank will have access to certain information when you applying for these loans. So will be very important for you to note this number. If you are looking for government assistance program, I'm going to give you a number to call. You can initiate $2,000 online for Canada Emergency Response Benefit, CERB. The number is 1-800-959-2019. 1-800-959-2019 or 1-800-959-2041. You can either go to canada.ca or you can call this number to ask for benefit under Canada Emergency Response Benefit Program. Let's talk about the mortgages, why a borrower need loans or they need to borrow money. When a consumer decides to buy a property, buy a good or services, and they don't have the money to buy it, they borrow it. And this is where your relationship starts with the lender or a bank. So when you are looking to buy a home, you need financing. It all depends of what type of financing are you considering. there are component of the mortgage. You may have not explored that in the past, but for education purposes, your mortgage have 4 components of the mortgage. The first is principal, the amount that you borrow for the mortgage. Second thing is the interest you're going to pay on a mortgage. Then you have term of the mortgage, and then you will have amortization period, how long you want to amortize that principal that you borrow as a loan. So there are 4 components in this mortgage. So according to your ability to carry that loan, you arrange a mortgage. Canadian government has instructed banks to provide defer program. And we're going to touch base defer program because this first program, this is a very vast subject. So we're going to talk about different things and then how we can help you to do that and how you should be doing it. So the question is, when you ask for a mortgage, either you're looking for a line of credit, you're looking for a mortgage, or some people are asking for student loans. And as you know, right now, the government is supporting this because they know that if the economy is collapsed, particularly real estate, it will have a devastating effect on the recovery efforts. So they are putting a lot of money under the Canadians program to give funds to Canadians to support themselves. Why they choose 4 months? You know why? Because they think in 4 months, we should be back in normal. That means we will be able to control coronavirus spread and contain them, and the economy should move back in full gear. And that is why they are predicting first 1 to 2 months is to control the spread, contain it, and then giving this money so you are continue to spend, and they're supporting employer to continue to maintain the employment for the people. And some industries like restaurants and communities events, wedding halls, those are really affected. And lots of unessential businesses have been shut down. Construction has been shut down in Ontario, except essential. So these are the reason that to make sure that industry, economy come back and this industry continue to pick up where it stopped. Now, when you talk about the mortgage, so when you are buying a house, you're going to lender to getting a mortgage. And there are different types of mortgages. One is a conventional mortgage. Now, the purpose is to discuss this so you understand the mortgages. You may not have spent time with the lender or the bank details about it. So conventional mortgages, when you have 20% down payment and you don't need insurance from CMHC, it's called conventional mortgage. That means you have built your equity and you have equity in the house. And I think based on your equity, in troubled times, if you have paid for a period of time, you will be able to withdraw that money to support your living until you get back to business again and start making money. So conventional mortgage is normally 20%. If you are less than 20%, then you have to uh, go to Canadian Mortgage and Housing Corporation to get the loan. The other one, that is called high ratio mortgage, because you do not have 20% down payment and there is a premium to be paid. And now, looking at your situation right now, when you are deferring payment, we're going to talk about those things. I'm just giving you definitions. So many of us who are in mortgage business, they try to explain people. You might not have a chance when you're dealing with a bank that somebody explain you or sit down with you. So mortgage brokerage, brokers and agents, they have ability to explain to you. Now, a mortgage brokerage, when you are dealing with a real estate broker, I'm a principal broker. I'm a licensed by Financial Service Commission of Ontario, now they call FSRA. My license number is M08002130. My brokerage, which I registered, is Canadian Express Mortgage Inc. License number is 13241. So that means the mortgage industry is also regulated in the province of Ontario. So if I'm giving you opinion and giving you some ideas, I have a license because I'm a principal broker. I have a license for over 10 years now. And so finally I decided, because this pandemic, that I am capable of helping you understand and explain you. You got to have a license when you talk about the mortgage. So this way I'm able to talk to you. And if you need the mortgages, you will be able to call me and I can help you. So closed mortgage. Now, there is a open mortgage. Everybody talk about the open mortgage. But basically, open mortgage is a variable mortgage. Your mortgage rate fluctuates based on interest rate your bank charges. Depending what you negotiated with your lender. Lender could be bank or any corporation that is licensed to give the money. The advantage of that is that if you expect money coming to you, you are in a position to pay down those without waiting for any time. Whereas if you have a closed mortgage, you have a limitation, and if you try to pay off, there is a penalty for paying it out. It has to do with interest rate differential. I think I spoke about that in the past. So if somebody has a question, they can call me 416-451-3489, and I can explain to them again. So it's a flexible, but if you are an employee and your income is fixed and you do not expect any money coming from outside or a friend or family as a gift, I recommend you stay course with your fixed mortgage and go through the cycle, because this pandemic is related to health. Our economy was going high speed. We have no problem. It was going very, very well. Only thing is health issue came in, which we, the government of Canada and our province of Ontario, they have to shut down non-essential operation. And corporation who are not able to generate revenue because of restriction, they have to lay off employees. And that's why the federal government had these programs to help all of us. So in this case, people who are self-employed, we are We have no source of income. And majority of us not qualify for EI. We don't know at this time what is the agenda or the rule to get paid if you are retired, you are getting a CPP or other program, and you're still working and paying taxes, and all of a sudden this pandemic and business shutdown and no income, how they will consider you. So benefit is there that in this case, if you have income and you are able to pay the mortgage, fixed mortgage would have been a good option. So then you have a fixed rate mortgage so variable mortgage. Open mortgage means you can close anytime. Variable mortgages, it fluctuates based on the prime rate. So now in your situation, you have to review those things. I think you should open your file. Maybe you have a digital PDF copy and read through your mortgage agreement. It explains you everything. It should have. So now when we are doing is refinancing, because people have choice now, they are in this predicament, they have no jobs. Bank and lender will rely upon your credibility that you have. They will give you 1 month to 6 month deferral. There was a question raised by one of our following on our Realty Coffee Talk show, which I have, that they are charging money, interest on top of the interest. So I thought this is a very great opportunity for me to explain to you. Remember, I mentioned to you that when you have a mortgage, it has a principal and it has the interest portion. To my knowledge, bank has to make money. So if you are asking for deferral, you know what they are doing is deferring your principal contribution, but they're still charging you mortgage. Some may choose to do the both, but it's very unlikely. What happens is that when you pay a mortgage, let's assume 35–40% is principal. Let's assume its mortgage is $4,000. Let's assume that $1,500 is going to the principal and $2,500 is going to your interest payment. To my knowledge, the bank is still want that $2,500. But the $1,500, which is also part of the payment that goes to the bank. And if you are deferring that payment, bank is saying to you, if I defer this payment for 4 months, for example, so it's about $6,000. So I'm not getting that money. So I'm going to charge you back interest on that. Basically adding to your loan amount. Let's assume that you have a home equity line for that connects with your mortgage and you have a home equity line. If you pay $4,000 on a monthly basis, $1,500 will go toward your home equity line and it will increase you. Let's assume that your mortgage is paid up to date and your line of credit, home equity line of credit you have established a home equity line, and the moment you pay $4,000 to them, if you go to your online banking and you see the split, it will show you the principal paid, the interest charge and total amount. And immediately your home equity line will be increased by $1,500. Now let's assume that you want to draw that money back. You can draw the money back, but there will be a charge, interest rate, because this money belongs to the bank. Even though, because they reduce your loan, and next loan that you will be paying mortgage, your equity will be even increased because you paid that $1,500. Now you did not pay that $1,500. Therefore, that loan that you borrow again $1,500 back from the line of credit. You paid $4,000, you got line of credit $1,500, you took it out again. So on that $1,500, you will be paying the rate that you have agreed in line of credit, equity on line of credit. A prime, maybe prime plus 0.5%, 1%, whatever the rate you have. So are you not paying the interest on that? You are. Therefore, you're deferring that payment. It entitles the bank to charge you interest. And that's why they're charging you that money. It all depends how much loan you have, how much money you are borrowing, and how you're dealing with it. So I hope that that clarifies you. And I suggest and recommend to all of you, you go to online, when you make the payment of the mortgage, check your home equity line. If you did not have equity line, I recommend that you do. Under these circumstances, if you do not qualify for other reason, bank are giving line of credits. They're extending credit. Now, credit card could be a different. This will be very, very difficult to even talk about it. So basically what's happening is, bank, when they borrow money, even though we have an emergency situation, government is supporting institutions to help us. But they look at their habit. They look at your leverage, your capability to pay back the loan. So one of the worst things that we do between us, having abuse of credit cards. We think this plastic card mean nothing. We just have it, we go there, shop it. I am a culprit of the same thing. I buy things that sometimes I don't need. Sometimes I return them, get back my credit. But the car, abusing the credit card is the worst thing because interest rate could be 20% and up. Second thing is credit card issued by other retailers such as Home Depot, Best Buy. I have bought something and after I know that now my 6 month was happening, so I paid out $1,000 on my Home Depot card because I borrowed stuff, but used the card to buy something for a home renovation. You know, interest rate was almost 30%. So should I pay $300 on $1,000, or I just paid off, borrowed money from line of credit, which is 3% or 2.449%, and paid off. So this is why it's very, very important to look through your consolidation effort. Talk to a counselor who give you a financial advice. The worst thing that we do in a normal case, and now we are talking about coronavirus and pandemic, is missing payments. When you miss a payment, unless it's approved, I'm talking about deferral payment now. If you do not pay until your defer is approved, you fall into default category. If any possible scenario the way you can get some help, it will be denied to you. So that is why it's very, very important to control our financials and make sure we do not miss any payment. The other thing that we have as a human is spending more than what we can afford. Why we get these debts? What is important to us? When we can't afford it, we don't have the money, why we spend it? What is more important to you? In our life, food on the table is important. Paying for student loans for children to go to high school, buying clothes, essential, having at least a car, and insurance, because we need. My son actually suggested me to suspend the insurance for 2 cars because we have 4 or 5 cars because you're not using them. So I totally forgot. So I'm going to be calling my insurance company today that these 2 cars are not being used right now until coronavirus is there. So we will use only one car. That's a good idea. I may be able to save some in premium because I think the insurance companies are allowing it to do that. So try to control your habits of not spending money, not only in this pandemic or any time during life, to be financially responsible. Most important thing in any type of crisis is having a financial cushion. When we did not expect this coronavirus. It came to us unexpectedly. Were we prepared? We were not prepared. Majority of them, I wasn't prepared. I do have a little cushion. This is very important to do some saving. I highly recommend that. Going back to rethinking, no new way of getting our life together, doing business. To start saving, do not spend more than 30 to 40% of your earning. So you can build some cushion for 3 to 6 months that you can survive. As you can see, the federal government has given deferred mortgage payment for 6 months because they see it takes that much time to get back to the business. People are gone, they're isolated, they lost their jobs. Now they need to be restored, rehired. There was a good news that Air Canada was hiring back, WestJet was hiring back 6,400 employees. So that's a good indicator. I am fully confident that what initiative Ontario government have taken and the federal government to control the virus are worth it, because it will limit the time we have to remain isolated and practicing social distancing. So if we are going to now, as you know, 23rd April. So we have plenty of time to educate ourselves, prepare ourselves, do soul searching, what have been doing, where we can improve. This is the time to think about that. And we need to be more disciplined with our money. It doesn't mean that anything that we earn has to be spent. We have to be cautious about it and create that cushion for us so we are not able to lose out under these extreme circumstances. Impact would have been a little bit better, because if you look at the debt our debt, I believe, is a $1 to 1.79% of total debt the Canadian carries right now. So it's important. So we want to make sure that we avoid all these things to make sure that we have a cash flow. That means we have the money. Have you thought about that? When everything is going good and we feel that there is no need for do saving because I have a job, I have a business, and all of a sudden everything is shut down and you have no more income. Good thing is a government-initiated program. So if you don't have a consistent cash flow, even you are a corporation, you have a problem. And the bank will not loan you money because you are not demonstrating that there is a cash flow, there is a business income coming, because right now it has been stopped. The other thing why bank give you money is a collateral. If you have insufficient collateral, the bank will not give you money. That is why Canadian Mortgage Housing Corporation was established to give money to homeowners, new buyers. They have a credit, give you land transfer tax up to $4,000 if you're a first-time buyer. We haven't bought a house in Canada or around the world actually, but particularly in Canada. So bank look at the asset, your ability to earn money, pay the loan. You have asset, so they can recoup their debt. If that lacks, bank will not consider favorable to you. When you are applying for a loan, you make sure you have T4s, T4As, or mean of other income. If you have a dividend coming from your corporation, all income. You file your taxes in, the tax return, you have a notice of assessment. Normally, 2 to 3 years of documents are required as a minimum. Notice of assessment. If you're a self-employed, T1 is required. And you give all the asset, declare all the asset that you have on the application. Social number to verify, because they will be putting a credit. So I recommend that you frequently, or at least months or quarterly, pull out your credit report. I think at this time right now, when you are going for a mortgage or loan, I think it's a good idea to pull your own credit report. Go to Equifax or TransUnion, so you can see how the lender has gone and checked your credit each time that you have asked for a different loans. If you apply for a mortgage, that would be one charge. But when you apply for mortgage and you also have other loans, credit cards, student loans, you bought furniture through a big retail store or Best Buy or Home Depot, all those credit will be shown, and they will be frequently inquiring about your credibility, your creditworthiness, that you have not delayed any payment. So this is very, very important. They also looked debt to income ratio. I mean, how much debt you are carrying and how much is your loan is right now before you get any extra loan. Because they look at the income to debt ratio. If it's high and you are a very risk factor, it's very, very important. Remember that when you borrow money from the bank or a lender are private corporations and also individuals, private loans. But with the corporation, with the banks, they borrow money from public to lend it to you, and they make their money. Simple. I'm going to use a layman language. If someone who's wealthy has put a money in the account Bank pay them 1-2% or whatever the rate is. They negotiate with the bank. But then you and me go for the mortgage, they charge you 2%, 3%, 4%, whatever they want. And if we get for the car loan, why the car loans are high? Because there is no value they see in a car. And normally the new dealer give you a better loan because they charge you up to 10%, 7, 8, 10%. Bank will charge you 7, 8, 10% buying a car because it depreciates faster. Whereas a property in last 10 years had more than double in real estate. So now, if you have insufficient credit, do you think the bank or lender will give you money? No. Because you have utilized all your equity you have in your home, business, or property, commercial, income property. And this is where it becomes a challenge. Sometimes, as you know, as a principal broker, I have access to the bank to get financing for you. And sometimes all mortgage brokers who are working in, I'm talking about consumer residential homes, we get a small percentage, maybe up to 1% of the loan amount as a fee for providing the service. It is paid by the lender, not by the consumer. And we have the ability sometime, depending on the client, that we can discount the rate. If bank give you a rate, and I decided that, help you out. And if they give me 0.8, I tell them, okay, give them 0.3 to them and just give me 0.5%. So your rate will come down. For example, if it's 2.49 to 2.19, I'm giving you an example of that. The mortgage broker and agent have the ability, basically, what they are earning are the one they are saying, okay, because my client is in trouble, they need some help, I will sacrifice to help them out. They give discount, which bank will not give you that. And this is the advantage of working with the broker. I'm a principal broker. You can talk to me, I can find out and get back to you. But if you are dealing with a bank, they have big corporations, they have certain policy and procedure, the guidelines, they follow it. After that, they can't do that. We can discount. Now, the other thing is when you are, remember I talk about the personal guarantee. If you are in a challenging position right now where you cannot get the mortgage, refinancing, or afford the mortgage, you might get a personal guarantee from a family, friend, and a member. Idea is not to lose out. When you have a mortgage that bound to default because of non-payment, what you're supposed to do? You're supposed to talk to every person that you know who is capable of helping you out. Talk to the friends, talk to the family. And sometime you will find a buyer who will negotiate with you and do equity ownership in your house just to safeguard your equity in the property ownership. Because bank will, normal case, let's say it's less than $1 million house, bank will only give you 80% maximum based on the appraised value of the property. $1 million house, you get up to 800,000. Let's assume your mortgage is 700,000. So that means you have 100,000 equity. That's sufficient to survive under condition. Plenty to survive 6 months and 9 months, depending on the situation, and you can be okay. But if you are a person who has high risk mortgage, loan to value is less than 20%, you put 5 or 10%. So if it's a $700,000 house and you have put 10%, so you have 100,000 equity. So 20%, the bank will only give you 80% of the 700,000 if you put down 10%. So you have less money available to you, and in the meantime you have an equity line, and you've been using the equity line to buy those things that we talk about, things that you shouldn't be buying it and we're spending money. So your equity line has no room there left anymore. In those cases, you need to think seriously. If bank is not giving you extra credit, you have insufficient, we call credit, and you don't have a collateral, the bank will keep that 20%. And in case you have no way of getting money, government support, money from friends, or alternate financing, then you may consider talking to friends or people, or your even realtor, to see, help you out, find a person who will be a terminate the mortgage, considering all the factors, and sell your house, or create a partnership with someone, and you have a personal guarantee from it if there is no personal guarantee available. Idea is not to lose the house, the equity that you have, to mind fine. Now, if you are a business, small business, who doesn't have a history, so it will be tough for bank to give you the money if you don't have established history. So self-employed, contractors, renovators, plumbers, electrician, they make lots of money. But if you are a small assembly manufacturing or other businesses, you have no access to you've been new, so you will have an issue. Always, when bank think about the money, they look at the economic concern. What are the economic concerns? Uncertainty, pandemic. What happened is, our economy was going great. As you know, real estate, we have tremendous boom in March. Almost 15.9%. Sale went up. It was going like this from last year to this year. In March, 15 to 30 March, it declined over 15%. Sales, but not the value of the property. What does this tell you? People are waiting to go through this cycle, because we will pick up where we lost. It's just an uncertain time when the government will decide to lift social distancing and people start hiring. As you know, I mentioned that WestJet already started hiring 6,400 because it was impacting their operation. So I'm very soon, very soon, I'm hoping that everything is normal. We may have April or mid-May, probably by end of May, we should be back. And those people who have been laid off will be hiring back. So this is the concern. Actually, that was not the concern of Canada. Our industry was booming. Everything was working very, very well. Only, unfortunately, this happened is that health issue. We have to lock down. Our prime minister has to lock down. Our premier material has to lock down the operation for the safety of the people. Home isolation, we are enjoying it. We are talking to you guys, and we're finding ways to communicate with people. So economy will go back. Sometime, if we don't manage our asset, our financing is concerned to banks, lenders. Why to give you money? I'm talking about development projects, lots of construction projects, subdivisions. I'm a part of one of the subdivisions that we're waiting for TNO registration. It's on hold because we can't do construction. So, but the cost of carrying the money that was borrowed to build the project, development, that is still going on. So if you are a part of a team, management team, if you don't have a team to run a corporation, bank will not give you money. So be careful before you laying off people, because you need management. That is the confidence that bank has on you. And is our industry weakening? Element of weakening is that industry is not doing anything. Last night broadcast Realty Coffee Talk, I told you, because I'm a real estate broker of record for City Pro Realty Inc. Brokerage, that industry is doing phenomenal support for their fellow realtors in real estate, because I am a real estate broker of record for City Pro Realty Inc. Brokerage. So I can talk about that. You have to talk about other industries, if they're essential or they're not essentials. Our industry is not weak. We still will be getting about 1 million immigrants when this is over. And we need them now more than ever, because we need to stimulate the economy. As I mentioned to you, the government of Canada has bought $150 billion worth of loans from the bank, mortgages. You know, this is a funny part how this functions. We borrow money from the bank. Bank borrow money from the public or through the federal bank, and they charge extra money to make money. Then they have these mortgages, which is sold as a security to people, and banks sell your security to various big organizations, trust. And then at the end, if everybody is being impacted, what does the government? Government say, I buy your all mortgages loan. There are several $1 billion they are buying every week, every day. And they invested, they took away immediately $150 billion of current mortgages. And they have trillions of dollars now mortgages that is owned by the Canadian government. That means the bank has more money to give it to you as a loan. So this is a very tough time. And as you know, the two important things that you need to maintain is that stress test is still there. The stress test, do you know what the stress test is? The government of Canada, there's a benchmark test, right now is 5.14%. If you are a conventional borrower, 20% up, and bank is offering you 3% for your mortgage, they will add 2% on top of your ability to carry the mortgage. So they are saying is basically that let's assume that you are paying $3,000 a month, and your interest is 3%. And all of a sudden the rate changes and your mortgage, particularly if you are carrying a variable mortgage or open mortgage with fixed element, it increases to almost 5% of the mortgage that you pay. It goes from 3,000 to 3,500 a month. They want to make sure you have the ability to carry that shock from 3,000 to $3,500 because the fluctuation of the rate, if you're variable or open mortgage. This is very, very important for you to understand. The mechanisms are there to protect not only the borrower and also the bank. So we have to make sure that how this stress works and you know that you are capable of doing it. It is still applicable and you have to qualify. Now, in order to qualify a mortgage, there's another scenario. They will look at to see if you have certain amount of income and if your mortgage is $650,000. You qualify based on your income that you declare to a bank or lender. Let's assume it's $650,000. Under the stress test, you only qualify for 600,000. So you lose that 50,000 because that's part of the contingency fund, the stress test. That means you qualify for less. If you go to any bank, you can go and search that. Other important factor is interest rate differential. If you have open mortgage, you can pay out anytime. If you have an open mortgage, but it has a closed term, you will end up paying some interest. That's a 3 months interest. But if you have a fixed mortgage, you have to pay is called penalty for interest rate differential. It is applied when they give you the discount at the rate at that time. They will minus that rate, and they apply the new rate and minus that. Let's assume you have a 6% before and now it's 5%. So there is a 1% difference. And they look at see how many years you have left. And they apply time those years, then apply to multiply with the amount remaining. So each bank does differently. You have to make sure that you check that out when you are negotiating your mortgage. So borrowing money is taking responsibility to ensure not only that you use money wisely, but also manage it wisely. Do not spend more than what you can afford to keep a good use of your financial resources as a availability of cash flow available to you under contingency plan. Because times such as pandemic, because deferred payment of mortgage, credit card, store credit will further exaggerate your situation when you are recovering. You have to seriously think that if you cannot afford now, would you be able to afford it a later time when this loan debt will come back again? So this is a very, very prudent. I highly recommend that you speak to a financial counselor who give you guidance. Look at your financing and do the planning and get some advice to make sure that you are managing your asset, your resources, your credibility, credit is very, very important. It's in your hand. It is you to make the difference in your life and your financials for a better future for you and your family. I thank you very much for listening. If you have any questions regarding the mortgage and financing, I'm a licensed principal broker of Canada Mortgage, Express Mortgage Inc. I'd be more than happy to assist you. You can call my number 905-785-9926 or my direct number 416-451-3489. My passion is to help you to achieve success. Thank you for watching. Good night for now. May God bless you. Keep safe, stay home. May God bless Canada. Thank you.